I need you to stop what you're doing right now. Something happened on Friday that Wall Street could not control, could not price in, and could not react to in time. And by the time the opening bell hits Monday morning, every algorithm, every hedge fund, every trillion-dollar institution on this planet will be forced to release 48 hours of silent pressure into a single moment. You need to understand this before it happens, because there is a very specific kind of silence that shows up right before something breaks. Not the silence of calm, but the silence of compression. The kind of silence you feel when every door is locked and the temperature keeps rising. That was the silence sitting over U.S. financial markets on Friday, April 3rd, 2026. And if you didn't feel it then, you're about to. Friday morning, the Bureau of Labor Statistics released the March jobs report, 178,000 jobs added. Unemployment dropped to 4.3%. On any normal Friday, those numbers would ripple through markets in seconds. Desks would light up. Algorithms would reprice everything instantly. But this time something was different, because billions of dollars are about to move before most Americans even finish their first cup of coffee. But here's the problem. Last Friday was not a normal Friday. It was Good Friday. The New York Stock Exchange? Closed. Nasdaq? Silent. Bond markets? Shut early. Every major cash equity market across the United States completely frozen. And at the exact same time, the most important economic data in months was released into a system that couldn't react. No buying, no selling, no hedging, no price discovery, just silence. And behind that silence right now this weekend, while you're watching this on OG John, the most powerful financial institutions on the planet are not resting. They're running models. They're recalibrating algorithms. They're stress testing trillions of dollars in exposure. They're preparing for a single moment. Monday morning, 9:30 a.m. Eastern. Opening bell. And what they're preparing for is not just a reaction to a jobs number. That jobs report? That's just the trigger. The explosion has been building for months. So let me show you what's really inside that report. Because the headline number, that's a masterclass in misdirection, 178,000 jobs, sounds strong. It sounds resilient. It sounds like the U.S. economy just bounced back. That's exactly the story being sold. But when you go beneath the surface, the picture changes. February wasn't 92,000 jobs lost. It was revised to 133,000, a 44% deeper drop in a single revision. That alone should have dominated every financial headline. It didn't, because March was used to bury it. Now look at where the jobs came from. Healthcare added 76,000 jobs, but nearly half were just workers returning after a strike. That's not growth. That's normalization wages. Up just 0.2%, below expectations. Annual wage growth? Down to 3.5%, the lowest since 2021. Hours worked? Falling. That's critical, because historically, companies cut hours before they cut people. Long-term unemployment is rising. Discouraged workers are increasing, and they don't even show up in the headline number. The broader U6 unemployment rate? Back to 8%. This is not a labor market recovering. This is a labor market quietly cracking. And here's the real risk. This data dropped into a closed market. No reaction, no price discovery, just 48 hours of pressure building in the dark. When the bell rings Monday, that pressure doesn't release slowly, it explodes. The Strait of Hormuz, the artery for nearly 20% of global oil, is effectively disrupted. Tankers can't move freely. Insurance is pulling coverage. Kuwait has declared force majeure. Iraq just cut 1.5 million barrels per day. This isn't a lever you can reverse with a headline. This is a physical break in the global energy system. And physical breaks don't heal quickly. But here's what almost nobody is talking about. Behind every trade this Monday, there are real people. A pension manager in Ohio responsible for 40,000 teachers. A university endowment funding first-generation students. A small business owner who trusted index funds with a lifetime of savings. Decisions being made this weekend in Manhattan will ripple directly into their lives. Now layer this on top. Bank of America just surveyed 210 institutional managers overseeing $589 billion. Cash levels jumped from 3.2% to 4.3% in 60 days, the fastest shift since March 2020. That's not caution. That's defense. Global growth optimism collapsed from plus 39% to just 7% in a single month. This is not sentiment drifting. This is capital repositioning for impact. Inflation expectations just surged from 9% to 45%, while growth expectations collapsed at the same time. Read that again. That combination has a name, stagflation. And stagflation is the most destructive macro environment for financial markets because the Fed can't fix both sides. Cut rates? You fuel inflation. Raise rates? You accelerate the slowdown. There is no clean move. Jerome Powell said policy is in a good position to wait and see. That's central bank language for, we can't act. Now look at what the smartest money is doing. Bank of America's survey shows sentiment collapsing and fear shifting away from AI toward geopolitics and inflation. That's not a rotation. That's a warning. And here's where it gets critical. Private credit, a $2 trillion shadow lending market, is now the top systemic risk. BlackRock is blocking withdrawals. Blackstone is facing billions in redemption requests. Morgan Stanley is seeing double-digit outflows. Moody's is downgrading major players. When the biggest firms all restrict liquidity at once, that's not isolated stress. That's contagion. And contagion doesn't stay contained. When capital gets locked, institutions sell what they can sell. Public equities, index funds, your retirement accounts. This doesn't stay private. This doesn't stay contained. It spreads fast through electronic markets, straight into portfolios of people who don't even know they're exposed. Your 401k, your IRA, your index funds. Because in a liquidity crisis, diversification breaks. Stocks, bonds, real estate, they don't protect you. They fall together. We saw it in 2020, in 2008, in 1987. When correlations go to 1, your protection disappears exactly when you need it most. Now layer this on top, oil just crossed $111, up over 50% since the conflict began. Every major recession since World War II except one was preceded by an energy spike like this. Energy is a tax on everything. Transport costs rise. Production costs rise. Food prices rise. Consumers pull back, corporate earnings fall, stocks follow. And this isn't temporary. The conflict is ongoing. Supply remains at risk. Meanwhile, valuations are stretched. Cape near 37, levels only seen before the dot-com crash. Moody's recession model? 49%, right at the threshold. JP Morgan is cutting targets. Goldman sees a potential 23% drop. And now all of this collides Monday morning. Delayed reactions, compressed into minutes. This isn't noise. This is pressure looking for release. Bank of America and Morgan Stanley are not calling a bottom. They're telling you there's more downside ahead. And these aren't perma-bears. These are the largest, most influential institutions on the planet. Now look at the real economy. Consumer sentiment just dropped to 57.9 near multi-year lows. Credit card debt? Over $1.13 trillion at 21% interest. Savings rate? Just 3.5%. Nearly half of Americans can't cover a $400 emergency. This isn't data. This is pressure building in real lives. A family in Michigan paying 23% more for groceries. A couple in Texas refinancing at 7.5% and watching home values fall. A graduate in Georgia with $68,000 in debt now facing reduced hours. This is the economy. And that pressure is now converging into corporate earnings, consumer spending, credit markets, and labor data, all at once. Goldman just flagged a multi-strategy meltdown, a once-in-a-decade hedge fund shock, and systems that just absorbed a shock like that? They don't get stronger, they get fragile. Gold is rising. Central banks are buying. VIX is at 45, extreme fear. And last week's rally? That wasn't a bottom. That was a trap. Because nothing fundamental has changed. Markets rally, people feel relief, and that relief is exactly what makes them vulnerable. We saw it in 2008. We saw it in 1929. The first drop creates fear. The bounce creates confidence. The second drop does the real damage. And now look at what's ahead. FOMC minutes. GDP data, CPI, inflation expectations. Each one can move markets on its own. Together, they create a chain reaction in an already fragile system. If inflation spikes again, especially after the oil shock, rate cuts disappear. That's stagflation with no exit. Now add this layer. Foreign capital is quietly pulling back. The dollar is weakening. Confidence is shifting. This doesn't show up in headlines. It shows up in pressure. And historically, this setup leads to volatility. Not panic, but movement. Real movement. Here's what matters most. The data is already public. The positioning is already happening. The system is already set. The only people surprised on Monday will be the ones who chose not to see it.